Hello, everyone. Hope you're doing well today. I'm Harry Nima Segara. Many of you probably know me already. I'm the founder and manager of Nima Equity, a commercial real estate company, mainly with two focus. Like the first one is education of financial literacy and real estate, residential and commercial. And the second is passive real estate investing opportunities for physicians and healthcare professionals, right? Like, so our company is by physicians and for physicians. Today, I'm super excited about like our presentation and webinar, also with the presence of Omar Khan here, who is a very seasoned investor, real estate investor, syndicator, and also developer. He's the founder and principal of Boardwalk Wealth, with multiple successful exits in syndications and now also in development. Today, we're going to share with you about this new project, which is called the Jefferson Reserve Project, which is like a 180-unit multi-phase, three-story garden-styled Class A development in Sioux Falls, South Dakota. As you guys know, like always when I present this kind of opportunities to you guys. So first, like the first thing is like I also, or Nima Equity also invest like our own capital as passive investors. Number two, we try to always go to the site. So I'm happy to share that I'm joining Omar and the main team like in a couple of weeks in Sioux Falls. And the number three is like, so part also of my job is doing due diligence about our new partners and operators, right? So, and let me tell you this, like, so I have known Omar, or I know about him already for a couple of years, like 2 or 3 years. Like actually, when I was just starting, like I saw one of your webinars, like, and the topic was about how to invest from abroad, right? Like, so how a foreign investor can invest like in the US in real estate. So which I found that great. Like the other thing is that I have talked with 3 friends of mine who are also real estate investors and operators. And I asked them about like Omar, and I can tell you guys that I have heard only great things about him, right? Like, so like in some of the things, right? Like, I mean, I don't want you to feel bad or anything like that, right? But yeah, I mean, like, so a couple of things, like is like his strong asset management skills. Like number 2 is like how involved he's usually like in all these projects. Number 3, his communications and transparency. And number 4, what I usually like, and when you get to know Omar, you're gonna see this. He's very truthful. He is gonna tell you like things straight. He's not gonna sugarcoat you like anything. So I find that very, very important. And now my last 3 points about these projects that I want to mention, and Omar is gonna share a little bit more like during his presentation. So one of the things is like from the main partners, 2 of the partners are local in Sioux Falls. And so they're kind of like the boots on the ground for these projects. Together, we have like decades of experience combined in development and construction. And also it's important to mention that apart from us, Omar and the main partners are investing their own capital in this project. Finally, just one thing, like it's like, and Omar is gonna get a little bit deeper like in this concept, like the multi-phase project concept, and why I think that this is good for the investment and makes the investment less risky, like at the end comparing to other projects. So we can get started actually. Let me see if I can share my screen and get started with this. So this is our presentation, Nima Equity and Boardwalk Wealth. So let's get started with some disclaimers and disclosures, right? Like the following information is an investment summary provided to prospective investors and partners. This information is not an offer to sell either a security or a solicitation to sell a security, right? As a request, at the request of the recipient, we will provide what is called like the PPM or private placement memorandum, subscription agreement, limited liability company, and operating agreement. The managing partners, as in any investment in general, in no way can guarantee the projections contained herein, because like the real estate values, income, expenses, development costs are all affected by a multitude of forces outside the managing member's control. And as I always tell my friends and investors, just think about like these kind of investments, syndications, or development especially are illiquid investments. So you need to plan for that. And as I always mention, please consult your attorney, CPA, or financial advisor to determine if this is a good investment for you. And then you can continue reading all of that. So organizational structure is myself. Founder and manager, again, as we mentioned, of NIMA Equity. I'm still a full-time pulmonary and critical care physician. I work here in downtown Dallas. Have over 6 years of experience in residential and commercial real estate. As you guys like probably know, like I still own like a single-family homes portfolio here in Dallas-Fort Worth. And I'm involved in acquisition, sourcing capital, and also during the last year, asset management in multifamily properties. NIMA Equity is proud to co-sponsor in over 1,100 apartment complex units, co-sponsor, co-partner, and co-owner in 5 different states, right? And we, again, as I mentioned at the beginning, we focus also on financial and real estate education for physicians, and we also run a YouTube channel of the same name. So without further ado, I'm gonna pass this to Omar.
Thank you, Harry. I really appreciate being here. And hello, everyone. You can hear me, right?
Yes, perfect.
Wonderful. Okay, so I'm Omar Khan, the pretty face you see there on the slide. That's me. My background's in finance. I'm a CFA charter holder, which is a gold standard in portfolio and risk management. So I've done $3.7 billion, in capital financing and M&A transactions in my investment banking career. I've also raised, I mean, that is 50, we're well closer to $75 million now, $75 million of equity from private and institutional players. But most importantly, again, I think the slide is a bit outdated. We have to update it. It says in the end, we've closed on 280 million of assets. That's close to about 450 now. But the fact, guys, here is that I have a particular skill set, right? My skill set is putting deals together, asset managing them, understanding the capital market side, the loan side, and then having enough experience and a lot of people on my payroll to help me complement. Because as an example, all of these things are a team-based measure, right? No one person, no matter how intelligent they think they are, can do everything. And that's why if you go to the next slide, you will see that my partner, Dustin, he brings a certain skill set to the table that complements my skill set. Dustin is a very experienced developer, syndicator, investor. You know, he's basically been involved from real estate, from roofing, all the way to the development of these types of the types of deals you're going to see. And the reason why we want to have him in, because Dustin has a great design and layout and floor plan layout experience. Go to the next slide. You will see my partner, Caleb. Caleb is not just our partner, and we do all of our developments with Caleb. Caleb is a builder as well. He's a second generation builder. So that tells you there's continuity there and lots of local connections, which really help out. Apart from that, Dustin, Caleb, and I, we all have our lending connections, and invariably we are signing on the loan documents as well in some shape or form. So what does that tell you? What that tells you basically is, in case things go sideways, God forbid, because that's always the concern, right? What happens if you don't do this thing? Right? What happens if the market changes? What happens if you don't do this? What happens if the project doesn't work? Well, I like to tell you, those were the exact same questions that I asked from my partners, because I say, look, talk is cheap, but in case things go sideways, what skin in the game do you have? So apart from us 3 partners, our co-investment being anywhere, co-investment means, you know, if you have to raise, say, $10 million, you know, and we say it's a 5 to 10% co-investment, then 5 to 10% of that money we are investing, right? So that's what co-investment means. So not only is there co-investment anywhere from 5 to 10, in fact, on one project, it was 22% even. Not only that, one of us is always signing on the loan documents. In particular, Caleb is always signing on the loan documents. There's a big reason for that. The reason for that is very simple, because look, at the end of the day, if you're a builder, you basically, part of your compensation it's just built on doing the work, right? But you don't necessarily care whether the work is done on time. You don't really care about all other factors, whether you're living in a good environment, whether you're cutting costs, because you need somebody above you. And the reason, frankly, is because most builders will not sign the loan documents themselves. So these loans are recourse loans, which means in case the project isn't completed, in case the project is a failure, in case we can't pay back the loan, there is recourse to our personal balance sheet. Unlike non-recourse loans, where in case, God forbid, you screw up, nobody's going to come for your personal assets. So in case things screw up, people can and will come, by people I mean the banks, for Caleb, mine, or Dustin, say personal assets like our homes, like our cars, all of that sort of stuff. And the reason why it's important for you to know that is because you always need to know, is the person that you're going to entrust your hard-earned money to, do they have skin in the game? And skin in the game isn't, say, $25,000, $50,000 investment. Skin in the game means that if things go sideways, are they going to suffer the pain first or not? In very simple words. And I don't want to start negatively, but I always like to emphasize this message, because a lot of times what I see is everybody gives advice, but they don't put their own money on the line, right? They don't put their own reputation on the line. And it's pretty easy to give advice. And it's pretty easy to tell somebody, hey, go do this, when you yourself, as an example, do not have any skin in the game, right? So let's go to the next slide. So guys, basically, in fact, how about this? Let's just go to the first slide where you see the picture of the buildings. I want to say something. So if you go all the way back, yeah. So just one more. So the building you see here, this is called Reserve Flats. This is in Brookings, South Dakota, which is about 30 to 45 minutes away from Sioux Falls. Now, Jefferson Reserve, and we've got about 1,000 more units coming online that we're going to develop in the next year and a half. These are all following pretty much a similar business plan. And the business plan was like about 1.5 years ago or so. Wow, it's been that long. Like 1.5, time flies, right? Time flies, 1.5 years ago or so, we were building Class A trophy sort of, deals, and Harry's going to come in August and see, we're launching one of our deals. Basically, it's a launch party. We were doing that, but what we were seeing was that, look, the times were changing. Credit was going to get tight. And I mean, I wish I knew how tight it was going to be. I would have made a killing, but we could see where the puck was going. Credit was going to get tighter, and all the weak players that were not efficient were slowly going to be killed. Basically, it wasn't, you could see where this story was going, right? So what we decided to do was we wanted to have projects that were flexible, projects that were nimble, and projects where we can expand or contract depending on what type of feedback the market was providing us. So this project, by the way, was done entirely with our own money. And we always want to do this. We always, first of all, when we have a new idea, we experiment with our own money, just to make sure that when we take money from investors, it's not a gamble, right? Because we're fiduciaries. And as a fiduciary, your ethical and legal responsibility is that you just don't gamble, right? So I can take certain risks with my money that I cannot take with yours, because frankly, I have a different set of responsibility to you, right? So Dustin and I, we basically have another partner, Russ. We basically developed this project with our own money. Now, this is, I think, about 48 units. But what we really wanted to do was we really wanted to finalize and kind of perfect the floor layout plans, the building layout plans, and we really wanted to test what the market response would be. And in this plan, what the beauty of this plan is, as an example, number one, we do not have any amenities. So we don't have swimming pools, we don't have gyms, we don't have juice bars or yoga bars or co-working spaces. And the reason is very simple. When we did the math on our previous developments, we realized, look, these are very attractive amenities in terms of marketing, right? And our cost was, and to provide these amenities, our cost was anywhere from about $27,000 to about $40,000 a unit, right? So that's a significant cost. And what we were seeing is the bunch of our residents, these are all upper middle class people making at least $80,000 to $120,000 a year. Well, none of these facilities were being used. They were hardly being used. So the fact became that we had these cool amenities that would look really good on a flyer or whatever you advertise out, But nobody was ever using these things because most, if not all, of our developments were very centrally located in high traffic areas where all of these other amenities were around them, right? So you have a Planet Fitness, a 24/7, fitness and anytime fitness. And people would in fact prefer going there as an example, because now you have the social element also, right? You go meet your friends, there's a community element there. So what we were realizing is we're spending all of this money, but we're not necessarily getting a discernible benefit out of this, right? It's not like we were able to push rents above the market ceiling, as an example, right? So we were like, okay, number one, that was a problem. Number two, what we realized when we built this project, this was our theory, but we wanted to test it in the market, was that when we build this out, what we have are interiors that are class A++. So we blow out the interiors, right? Because we're saving a lot of money. So you can add a little bit more money, completely blow out the interiors. So when the person actually steps into the unit, they are just, they're wowed. Literally people have said, wow, this is such nicely designed. The finishes are so high quality. And the key is focusing on small elements. Any item which you can usually touch, right? Say a door handle or a cupboard hinge, right? Not a cupboard hinge, the pull that you have on the cupboard, right? Or the faucets that you have. Typically, if you spend like 5 or 10% more, you can get a much higher quality, much higher feel type of project. And that's the type of thing when people touch and feel it, immediately they're wowed by it, right? So what we saw is, as a result of not spending $25,000, $27,000 to $40,000 a unit, our rents only went down by, say, 7 or 12%, but our costs went down by about 25% to 30%. Now, you don't need to be a math genius to realize if your costs go down by 2 to 3x more than your revenue goes down, you're always going to make money, right? You're always going to take that deal as much as possible, right? The other thing that we also had to figure out here, and we had this theory, but we wanted to perfect this, is that, once we do the horizontal work, what is the horizontal work? When we get a piece of land, you have to even it out, right? You have to make sure everything is even, the land is done properly. Once you do the horizontal work, what we can do is build a building. So as an example, on the left side, you see a building, right? You build it. Now, when you go towards building the second building, you're already leasing the first building, right? So it's not like you have to build all of these buildings like a typical development, right? And then start leasing it out. You build one, you build the second one, but lease the first one. Build the second one, now you're building the third one. You're leasing the second one. Couple of advantages there. Number one, cash flow right from the start. You're managing your cash flow better, right? Because any cash flow that you have from building one, you are using to either reduce your interest or reduce your debt overall in the project, right? Even though you're getting a draw from the bank. Number two, what's going on is that as you're doing this, by the time you get to your last building, now you probably have 6 to 9 months worth of data to show your lender that, hey, look, we didn't get to all the way to the end. We didn't build all the buildings and then start leasing it. So building one I built, here's all of the leasing data I have, right? Here's how fast I filled it up. Here's the rents I'm getting. This rent has continuously been paid for so long. I built building 2. Here's the rents I'm getting. So by the time you get to your third building, your lender doesn't make you wait 9 months, 12 months like they would if you had to build the entire thing, because they are already seeing the progress of what's happening, right? So there, what happens is you can refinance your money quicker as well. And lastly, the biggest thing for us is, because we always look at the downside, right? I mentioned I started off with skin in the game. Those are just, we are, a lot of people think we're in the business of real estate. We're really in the business of risk management. Like, how can we reduce the amount of risk we take to maximize the amount of money we can make? Or as a mentor of mine in my investment banking days said, son, as long as you take care of the downside, the upside takes care of itself, right? As long as you don't lose money, you manage your risk, you're going to make a shit ton of money. So I don't know if I can say shit, but whatever.
That's all right.
Right? You can make a lot of money, right? So managing risk is very important. So for us also, what was important was in this build 1, lease 1, build 2, lease 2, build 3, lease 3, and go on. What we also wanted to see was, well, what happens if the market slows down, as an example, right? So because that can also happen, right? We are building a great product, we've got a great team, but the market slows down for some reason. And in our particular case, what we wanted to figure out is, look, if the market slows down, we want to have a product where we can slowly actually reduce the pace at which we're developing, right? To allow leasing to catch up to us. So think about it this way, right? We build the first building, we're on to the second building. We thought, as an example, the first building in its entirety would be leased in 2 months, but maybe it gets leased in 2.5 months. Maybe it gets leased in 3 months, right? So instead of going all out on building 2, we will then start slowing down the building to process just by a little bit, right? Couple important reasons here. Number one, we're matching our building to our leasing, which allows us a lot of flexibility, but slowing down the process, or by the way, increasing, because if we thought it was going to lease in 2 months, it leases in 1.5 months, so we can hasten the pace of developing, right? What that allows us to do is never draw too much from the lender at any one moment in time to manage our interest rate exposure as well, right? Because typically what happens is developers will develop till they overbuild, right? And then they go, I mean, you're just swinging from one extreme to the other. Either you're overbuilt or you're underbuilt, right? And what we want to do is have a middle path that we chart through. In case things don't go or don't go the way we want to have the ability to pull multiple levers at the same time. So that's basically, I mean, it's a long way to say that we wanted to have maximum flexibility. We wanted to have maximum operational ability. We wanted to have maximum development ability to ramp up or down. And most importantly, when we're dealing with lenders, they love this type of business model because it starts cash flowing earlier, right? The earlier it starts cash flowing, the more data a banker has to make a judgment call on how quickly will they be able to refinance us. And in this environment and other environments also, that's really what bankers are looking for. Because if you think about it, the maximum a lender can get, the lender can get is the interest rate they're charging, right? So the interest rate is 6% or 7%. That's the maximum they can get. The minimum they can get is 0, right? So they are just playing the game of not losing money, whereas we are playing the game of maximizing money, right? Because theoretically, I mean, we could make 15, we could make 50, we could make 100 in a theoretical world, right? So we're playing the upside game. But when we take care of our lenders, when we manage our risk, we give ourselves the highest probability of maximizing our returns over the long term in a safe manner, right? Because look, you can maximize returns by levering up too much, by overdeveloping very quickly, but you don't want to go down that path, right? And lastly, the first point that I mentioned, I want to bring this back again, our co-investment is 5 to 10%, and we sign on the loans. So this means that in case, God forbid, things do go sideways, because look, there's that possibility, and I'm a very upfront type of person, right? So I always start with that, right? In case that goes sideways, number one, we have personal recourse. So there is going to be a lot of hurt on our side before anything happens to investors. And typically we are the biggest investors in our buildings and our projects. So what also happens is, God forbid, if something goes sideways, we are also hurt from a financial point of view. And that's what you want in your sponsors. You want sponsors to feel the heat if they don't do the work, right? And we like to put our money where our mouth is, basically. So why don't we go ahead?
Very good. Very good. Yeah, I like the fact about like the proof of concept that you guys have already, like one example that is working already and that we're going to open very soon.
Right here, a couple of more things I want to point out. In the bottom right, you will see that the interest rate is 77%, and the leverage is 70%. We actually have a term sheet signed basically that says our interest rate is 6.79% fixed and our leverage is 75%. So again, the underwriting is conservative. So just so that, again, we want to sandbag, right? We want to make sure we stress test the stuff, but the actual terms that we get from our lenders are significantly better, both on rate as well as leverage, just to give you that idea. And again, part of the plan of over here is this building is going to be built in 2 phases. Phase 1 should be done in about 10 to 12 months. We're going to then refinance proceeds and to fully or partially fund phase 2, which is going to be built in another 10 to 12 months. So in total, anywhere from about 22 to 24 months, you will have the entire phase 2 delivered, the entire 2 phases delivered. And phase 1 investors will get a 5% bonus shares, basically, right? So but phase 2 investors will not get it. So this means basically that if you're a phase 1 investor, you will, let's assume you invested 100 grand. When phase 2 starts, we will give you 5% bonus shares. So from phase 2 and onwards, you will be basically making money as if you had invested $105,000, right? But the cash flows from both phase 1 and 2 will be coming to all investors. So then your money is spread out over even more units than you would if you just invested in one phase, right? So it allows you to diversify. So let's go ahead, please. Yeah, let's go ahead.
And I just want to tell our investors and friends that they're all going to have like this full presentation. So, I mean, like if for any reason where we don't have the time enough, like to go over everything, they're going to have that in the next email.
Of course. So this is a very important slide. And this, man, I would like to say I, can make decisions, but it took me about 1.5 years to make this decision. So what this slide basically says is, why basically Sioux Falls? That's a question I asked myself. That's a question my brothers asked me. That's a question other partners who are not in this development with me have asked me. And it's very simple. I've had my partner, Dustin, for a long time. I mean, I've known him for like 5, 6, 7 years now. And we've done a lot of value add acquisitions in the Southeast. He's been a great partner of mine. And since the day we met, he has been telling me, hey, you got to look at Sioux Falls. You got to look at Sioux Falls. You got to look at Sioux Falls. And I've always lived in big cities, right? Or rather bigger cities. So I would always be like, why would I go to Sioux Falls, right? I mean, which was my stupidity. I'm not trying to like say I was good. And then one day, my wife basically said, look, Dustin's such a great partner of yours. So you got to give him a better reason than I don't feel like it, because that's not a real reason. And I said, okay, you know what? You've got a point, right? Also, I didn't want to argue with my wife, right? So you've got a point. So I did what I did in my investment banking days. I thought, I'm going to let the data speak for itself. I'm going to go to publicly available data sources. By the way, you can see on the bottom right, it's the Federal Reserve Bank of St. Louis, which is, again, publicly available data, right? And what I thought was, okay, well, I'm going to take out unemployment, household income. I'm going to look at industry concentration. And what I'm going to see is, okay, what does this thing say, basically? Like, what's going on? So again, another question, why Sioux Falls, right? I get asked this question a lot. And apart from all the stats that I provided you, what I really liked, as I told you, I was researching, right? So what I really liked is that it has a very diversified economy. And by diversified, I mean healthcare, financial services, back offices, food, agriculture, processing, manufacturing. The reason why it's very important, and biomed, by the way, is very big over here. The reason why all of this is important is because you don't want to be in a town, as you know, that has like, say, one thing, like say energy, like Houston, right? And it's great when the going is good, but if the energy markets ever turn, which they do from time to time, right, then you're basically stuck. We want to be in markets which are well diversified. No one industry in the market is like the biggest player. It's well diversified, multiple people are there, and most importantly, educated people are there. That's why the education is so important, because when you have a very healthy, robust university and college system, you are continuing to attract a very high caliber of people that will both be very high caliber, just period, because they're educated, but also they have the ability to make more money. And when somebody makes more money, it contributes better to the economy. It makes it better and easier for us to do our jobs. So that's a big deal. Now, if you move to the next slides, a couple of other points that I wanted to discuss. Look, I'm not going to bore you. You can look at this in your free time because you're going to get the slides. But if you go to the unit mix, which is the next slide, you'll see, we have a unit mix that is between studios all the way to 3 bedrooms. Now, the reason why this is important is because you don't want to have... So you don't want to have a building that's just one thing, right? You always want to give your property managers, your leasing agents, the ability to actually go sell something and cater to a wide variety of audiences, right? I mean, this property is actually pretty near a very leading school and a couple of other healthcare facilities like 2 hospitals, a couple of clinics, all of that stuff. So we want to capture people at all ranges of the value spectrum, right? Somebody that needs a studio all the way to 3-bed, 2-bath. And by the way, these effective rent numbers that you're seeing, we have really been conservative here. As an example, we're delivering Blue on the Rain, where our 2 beds, 2 baths. Now that's a slightly better quality building, right? So I'm not gonna say it's the same quality. It's on the lake. There are 2 bedrooms, 2 baths are going anywhere from about $2,500 all the way to $3,000, right? So that gives you an example of the range of outcomes that you can see here. The next couple of slides, again, don't want to bore you. You can see the rent comparables to give you an idea, okay, what are some of the other properties? If this slide, the timeline slide that you see on the next slide, I believe this is very important. Now, the zoning and all of that stuff is done. So land development zoning, even though it has these navy blue boxes over there, this is all done, but you need to do other elements in the zoning, right? For instance, you need to do all the horizontal work. You need to do some of the soil testing work. So all of that work is included in this, but it's all fully zoned, fully entitled, ready to go. There's no zoning and entitlement risk. Let's go to the next slide, please.
Perfect. Yes.
right? This is the operating pro forma. Now, the reason for year 1 being less and year 3 being higher simply is that we are going to deliver, say, this is from the month of first delivery. The first delivery is expected to be month 10. So what basically happens is through the first year, as you start delivering more units, you start getting more revenue, right? You're ramping up in year 1. And by the time you get to year 3, you're fully matured out. So that's why you see the income and the net operating income and everything, they start slowly before they just increase. Same with the real estate taxes. The real estate taxes in South Dakota typically have a 2-year lag. This is why you see in years 1 and 2, the real estate taxes are about $25,500. But boom, in year 3, that big tax bill hits us, right? That's going to hit anyone, whether it's us, whether it's somebody else is going to hit them. But you want to account for all of these things.
Mm-hmm.
Right, let's go to the next slide. Here, look, in total for 2 phases, we're expect to raise $10.3 million, give or take. We have 3 tiers of investment here. So Class A, for people who want to invest between $50,000 and $75,000, they'll get a 5% preferred return. People who want to invest between $80,000 to $145,000, they'll get a 6% preferred return. And individuals who are investing $150,000 or more will get a 7% preferred return. The splits at the top are all the same, 70-30 split up to 15% IRR and 60-40 above that. But the important thing that, as I mentioned earlier as well, Phase 1 investors get 5% bonus shares. Phase 2 investors will not get those bonus shares. Right. And the reason why you want to get bonus shares is because if somebody just gives you cash, then the problem becomes the IRS will tax you on it. This way you won't be taxed.
Okay.
Now let's go to the next slide, please. So here, again, the thing is, what I want to point out here is you can see the IRR equity multiple, but we're targeting a time frame of 46 months. This means from the time we take money, close on the deal, to the time, it takes about 22 to 24 months for both phases to be built, and then we operate for about 22 more months. That entirety of the time is 48 months. So as an example, if you take Class B, which is, say, 1.83x equity multiple. So what that means is for every dollar you give us, we'll give you $1.83 back, including your initial dollar, right? So sort of think of it this way as an 83% return. Now, it's not just an 83% return, because the average return here would be 83 divided by 46 to give you the monthly return times 12, which is a 21.65% annual average return, right? So you have to think about it this way, like, I wouldn't look at, it's another perspective of looking at it, but your average return is about 21.65%, right? IRR will obviously be lower because IRR has a component of timing involved in it as well, right? But I want to give you all that perspective so you're fully aware, you have 100% transparency into what's going on. Now, let's go to the next set of slides. I believe we've covered most of them, but if you scroll through our bios to get to our track record, you can see our investment process here. You can see about our companies here. But here you can see our current holdings, and it's also on the next page as well. So you can see that we are a very seasoned team. We've had value add, core plus, development product. And the reason why we've always done it is because we invest our own money into all of these projects. So for us, the simple question isn't whether to do development or value add. The simple question is, where can we take the least amount of risk to maximize our returns? And look, sometimes it's value add, sometimes it's development, right? For us, we don't necessarily in this regard have a stake in this, right? Like a lot of people say, I'm very passionate about development. And our simple response has always been, we're passionate about minimizing risk and making money, right? We're passionate about that. And real estate, we are very grateful to God, but real estate is just basically a good vehicle to do that. Right? But our first duty to our families, to our investors, to our partners is to make money, is to not just be in real estate, is to make money in real estate. That's why for us, that we go across value add, all these things. These are the sold deals you can see here. You can see typically, we say we want to hold for 5 years or so, but we're getting out by, say, month 30, give or take. There's one deal that was 39 months, but it's also had very high returns. So you can see we have a spectrum of returns across multiple markets and multiple different states. So that gives you an idea about our operating capabilities, because a lot of times one person is really good in their home, but they might not be as good away, right? And we like to be good home and away. Let's go to the next slide, please. These are some case studies. This is a Vertice project that I was mentioning. By the time, Harry, you're there, at least the first building should be right about done. It's not going to be fully done, but it's going to be right about done. So 1 out of 3 of these buildings you will see. Last year, if you go back, actually, just one thing. Last year, we signed a loan for 4.9% fixed for 5 years. And again, this is ahead of schedule. Wanted to point out that Harry's going to be there so he can report back to all of you guys as well. If you go to the next slide, that's blue on the rain. That's actually the building. This is actually the building we're delivering in August. And Harry's going to be at the launch party. We have a very accretive debt here, 3.24% fixed for 5 years. We're going to be in about...
That's awesome.
22 months. So we still have about, 38 months left on our loan. Initially, we had thought back in the day that, when we develop it, we will refinance into agency debt. But right now, every investor and every partner is like, don't let go of this debt.
Yes.
Go to the last day of 60 months and then refinance your money out. So these are 2 developments. The next 2 are basically value add. Do we have those or no?
No, actually, yes. This is the last one. Yes.
Cool. Sorry. So there you go. You have everything. Harry, let me know if you've got any questions. I'd love to answer anything that I can do to help. Yeah.
Yes, absolutely. No, thank you so much for the presentation. I mean, it was great. So I have a couple of questions that like before we go to the last slide, that my investors, I share already some information with our investors and friends. And if you don't mind, just we have a couple of questions.
Please go for it. I'm an open book. I'll go for it, please.
Yes. So number one, how often, after investing in this project, how often are we expect for updates in this project, and when are the distributions supposed to be started?
Every month you will get updates. This is the one thing we never compromise on. And I'll give you a very simple example, right? I have an investor of mine. She's given me money on at least 90% of my deals, right? And one day, she and I were talking, because we know each other's families as well now. And she was complaining that she has given money to this one sponsorship group, and she had a lot of difficulties in them answering simple questions. But at the end of the 3 years, it might have been her best investment she had ever made. And she told me, Umar, I am never going to give these people money again. And I didn't know the entire story then. So I was like, well, that's kind of weird. I mean, you gave them money. They made you a lot of money. Why wouldn't you give them money again? This doesn't kind of make sense to me at all, right? I mean, I want you to give me all of your money, but this doesn't make any sense, right? And her simple answer was that they would not send their monthly updates on time. Anytime she wanted a simple question answered, right? Because, when you give your money to a stranger, you have some apprehension, right?
Yes.
She's like, anytime I wanted to have a question answered, either it would take them a couple of months to get back to me, or they would not get back to me at all. So I just don't want to deal with that anxiety, right? So for us, we pride ourselves in never going down that path. You can just hear me talk. I like to over-communicate, not under-communicate. Right. So monthly updates are always provided. In fact, even during the months, if people have any questions, a lot of my investors, lots of my partners, they just literally text me. Right. And I'm always available. Right. Also, when our distribution is going to start, distributions will commence after the developments of both phases is done. So we're targeting about 24 to 27 months, but this is always a conservative estimate because typically it's earlier and they'll be paid quarterly. So at quarterly intervals.
Okay, very good, very good. The next question is, do we expect Sioux Falls population to continue growing in the next 5 years? And I think you already answered this question in one of the slides, but I want you to emphasize this, because again, not all of our investors are that familiar with Sioux Falls. And what are the main drivers for this population growth?
Look, Sioux Falls is one of the highest, I think it's a top 3 or top 5 ranked city in the Milken Institute. Milken Institute is a very well-respected institute that does all of these urban studies. This is also a top 40, basically fastest growing cities in America. On top of that, the building permit valuation, which means how much of your permits are increasing, right? Because if you have more people, you'll have more construction. That's just the way it is, right? Those were up 75% in 2022 versus 2021. So that gives you some ideas there on not only how the population is growing, but what are other reputable institutions that do all of these studies they're talking about? And then what's the reality on the ground with the building permit valuations, right? Now, how the key drivers, I personally believe, and this is done in my research, is there are no state income taxes, similar to Texas, low cost of living, very business-friendly climate. And the key industries, as I mentioned, are biomed, education, financial services, retail, food processing, manufacturing, and government.
Perfect. Then the next question is, have you or your company ever made like a capital call before?
Never. Not only have we never made a capital call, we don't even intend on having a capital call. But again, I always tell people, look, bad things can happen to good people. But a lot of times you can avoid trouble by not going looking for trouble. Like, don't be over-levered, right? Always have big cash reserves. Like my partners in the last 5 years would always bitch at me saying, why do we raise so much money and then we just put it in reserves? And it drives our IRR down and all of this stuff, right? And look, my family's, I'm the fourth generation now. My family's been in business in some shape or form across 3 countries. And the one thing that's consistently always saved us is not because we're intelligent, because I know my family, they're not that intelligent, right? It's the fact that we're always conservative and you always have ample liquidity on the side, because it's like an option, right? It's better to have an option and not need it than to need an option and not have it.
Absolutely. Yes, as Warren Buffett always says, like the first rule of investment is don't lose money. And the second rule is don't forget about the first rule.
Don't forget rule number 1, right?
Yeah. Right. And then like our last question. So one of my investors, he mentioned like, so this project seems to be a low risk project with, again, like we already own the land and it's owned already, it's ready to be built. We have a developer, a builder that are local, that are also invested in this project. And they are investing to their own capital. What do you think?
By the way, signing on the loan, just to be very...
Yeah, exactly. So what do you think is the worst thing that could happen to this project?
Look, you are correct. The project is indeed significantly lower risk than what you would see on a typical development syndication. I mean, as you rightly pointed out, this is because we've already completed the bulk of the work, because a lot of times you're getting into these developments and the zoning isn't done and the entitlement isn't done. And that's a big challenge, right? Because in some of these cities, as you know, these things can take years before anything happens. And by that time, that opportunity that you have is gone. So we have solid local presence, ample skin in the game. But the worst thing, in my opinion, that can happen is that we deliver the project in a time, when the macroeconomic conditions are materially worse than they are. So think about a deep recession or something like that, right? Now, in this scenario, an outright sale or even operations are a little harder than usual, right? But we have mitigated this, number one, by signing a 5-year fixed rate loan, right? So, and we expect at the high end for the total development to take 24 months. So in the case of like Blue on Lorraine, as you're seeing on the screen, we have a 5-year loan. We're going to complete this in, I think, by month 22, the entire building. So we still have 38 months left on our loan to weather the storm, right? Any potential storms that do come up. Additionally, in this particular case, we are reducing the risk of the project by doing this in phases. So you do one phase, you refinance out of it, right? Then you do another phase. And the beauty of this is that at no time, you don't leave your entire project exposed, right? You are leaving small chunks exposed at any given moment in time to further reduce risk. Now, can bad things happen? As I mentioned this right at the start, right? Bad things can happen and bad things do happen to good people. But what we can do from our side is take calculated, educated guesses and educated steps to ensure that, God forbid, if any bad event does happen, we are protecting our partners, our investors, and ourselves in the best possible manner.
Absolutely. Yes. And as we know, like the worst thing to happen, deep recession. So like the Feds will do the only 1 or 2 things that they know how to do. Like in that case, decrease interest rates, and then we will have an option like to refinance in that moment, like a property. Very good. Awesome. Let's see. No, again, like thank you so much, Omar. I'm very grateful, and again, like our investors too. So this video is going to be followed by an email, and also you guys can reach out to us. We're going to send an email. Like you can reach out to me through the website and also through our email. We're going to send like a self-commitment form. This is a first come, first base investment, so I need to be aware of that. This is an investment for accredited investors, and you guys probably know already the term, as we usually do that in our education. So again, like one more time, Omar, thank you so much for the opportunity. Thank you for coming with us for this webinar. Looking forward to chatting with you in Sioux Falls in a couple of weeks, and we'll go from there, man.
Thank you so much. I really appreciate the opportunity, Harry. Thank you.
Thank you.